Brian Pieri, founder of Energy Row. Brian, let's kick off this morning with some understanding of where U.S. oil production is going to go. I'm reading increasing headlines that drill, baby, drill is now a mirage in the desert.
Yeah, and Sean, thank you so much. Thanks for having me. And as you accurately articulated, the wave of geopolitics impacts and policy changes that have come about because of the Trump presidency, there are a lot of initiatives that have been announced, and part of this is a what I believe to be a political strategy of submitting 15 things for everybody to focus on while he's really setting the stage to maybe get five of them through. So there's kind of a flood of a bunch of different policies that are thrust at the market. You have tariffs, you have sanctions, you have a discussion of Gaza, which I quite honestly still baffled by that whole narrative. But when we talk about crude oil, let's talk about the fundamentals. The fundamentals are most of the growth in the United States over the last several years has been driven by the Permian. And that was driven by a lot of independents that were single basin owner operators. And they increased their operations in the Permian. What has happened over the last couple of years is a concentration or consolidation into larger entities. And with that consolidation, I see a slowing of development. It's going to be slower, methodical, but we are going to see kind of a constant growth. So instead of a rapid growth that we saw from 2022 to 2023, we're going to see a much more solid, stable growth, maybe 5-10% a year, something like that. We're sitting around 13.5 million barrels a day. And with the current rigs and current profile, I see maybe having a very similar arc for 2025 unless we see rigs change. In 2024, we went from 13.2 million barrels a day to 13.5. So not that much. I mean, 300,000 barrels a day is significant. However, it's not the previous adding a million barrels a day. So I see a continued steady march up. Some of the other basins are showing activity, but the fact of the matter is, with crude oil starting off the year down, that's going to dissuade a lot of rigs coming back to the table. So I see 2025 starting off with the same lens as 2024. We're just going to be treading water, maybe growing a little bit. So hopefully that helps.
Brian, just trying to get behind all of the noisy headlines, and as we say, things that are being actually done, and there's apparently and quite significantly in the U.S. in terms of policy changes that the executive orders are able to do, from the point of view of, kicking down the doors of schools where there might be illegal immigrant children, but ultimately, where is the rubber meeting the road in the specifics of what wasn't existing a few weeks ago for oil and gas and energy companies and now does? What regulations have been removed or are about to be removed? And will they not be enticing for oil and gas companies to sort of take advantage of? So what exactly is the change on the ground that has happened or will happen? And will they not be attractive to the oil and gas companies to sort of unleash and open their wallets?
So that's actually a great question, and that gets to the root of the matter. And that's one of the things that sometimes people miss, which is, well, what does this really mean? There's a narrative, there's a drill, baby, drill. What does that actually mean? And one of the things, I'm actually down in Houston right now. There's a conference called the North American Project Expo. It's where all the producers in the United States talk about their projects, try and get financing, and financing tries to find projects. So it's kind of a good matchmaking for independent producers in the United States looking for financing and projects. And one of the narratives that I've seen, is number one, you're going to see some of the larger entities cast off some of the smaller prospects that they have for development. Number two, anything that's up for sale right now seems to be mispriced to the higher side, meaning there's a lot of optimism as far as pricing, as far as policy. But the fact of the matter is, from the policy perspective, from my view, is that I don't see any meat around what is actually being presented. Most of the drill baby drill from 2016, most of those policies, which we talked about it before, Sean, were they were focused on areas that actually had nothing to do with production gains, and it had to do with opening up Alaska. Guess what? We didn't do that much in Alaska. It was driven in the Permian. So most of the regulations, I haven't seen concrete policy changes that actually substantially push it forward. There is an industry-wide on the supply side optimism because of the policy being more friendly. One of the key areas that I do see change happening is in the Inflation Reduction Act, which included some policy around methane emissions. And those policies would have potentially shut in 40% of the United States production because it's older production, it's more leaky, it has some methane, and some of those penalties were so steep that it could have knocked off 40%. That they started walking that back during the end of Biden's term, and as it goes into Trump, I think it is a law. So there, I mean, one of the things that's very difficult is that is a law. So they will have to walk that back in a very methodical way, and
Which is
that's
the interesting thing, isn't it? I mean, even if there is a new government, obviously there are laws on the books,
right.
and yeah, the government may choose not to enforce them. You're not going to get arrested for jaywalking under this government, but it's still against the law to jaywalk. Are oil and gas companies going to jaywalk, or are they going to obviously abide by the law?
Well, let's put it this way. Many of the penalties and Inflation Reduction Act, what's unique about energy policy and some of these laws and some of these things, I've been in and around the trading side of the industry, and when Dodd-Frank came out, after the financial crisis, when I remember I was at a trading company and we had an attorney come in and interpret the law, even though it was intended for financial securities, it actually had spillover effect into derivative commodities such as crude oil and natural gas. And effectively, the lawyer said they're still writing the law, but it's going to be retroactively enforced to last April. And we're like, okay, well, what rules do we have to play by today? So it gets very tricky when it gets to that. And one of the things is the Inflation Reduction Act is in place and those penalties are in place. However, they aren't enforcing. It is like your example on jaywalking. And I see with the change in administration that they're just going to let people keep walking across the street until they figure out some policy way to walk that back out of the law or amend the law. So that's my take.
Yeah. But Brian, also in the US, which is at the point of becoming a major global LNG exporter, what impact are these policies likely to have on investment dollars into hard infrastructure that's related to the export of energy from America?
Well, that's actually a great question because I would say if you rolled back the clock 2 years, the entire globe was looking at this rapid expansion of natural gas in the United States as a good exporting resource that is continuing to grow. In 2025, we're set to add another 20% to our LNG exports. And if you look at the natural gas that is exported out of the United States, it's over 25% of our gas supply. So when you look at that and you have a US molecule that is worth, say, $3, 3.50, something like that, and in Europe it's worth 14, in Japan, Korea, it's worth 14, 14.15, something like that, you can start to see the economies stack up. So the economics are there to continue that LNG expansion. But between the LNG pause that the Biden administration went under, now the tariffs on Canadian imports that still impact, well, at least deferred, but discussion points for Canada imports for energy as well as Mexico, you have this dichotomy of a myriad of issues dating back to the LNG pause. Now China is sanctioning any U.S. LNG to China, well, U.S. LNG and coal. And now that makes the scenario a little bit more of an unpredictable trade partner. And to me, that casts more doubt with some of these LNG projects, which take 3, 5, 10 years to build. I mean, some of these facilities are massive, such as the one in Canada, Kitimat, which is going to be coming on this year as well. So North America as a whole is going to be adding probably 6 to 7 BCF a day, or a significant portion to the global LNG market. And now the U.S. has cast doubt on the long-term viability as a long-term counterparty in that, because are we going to face tariffs? Are we going to face, like, it's a little bit more unpredictable. And these LNG contracts, I mean, these are multi-year, 5, 10, 20-year deals. So I think it casts a lot of doubt on any project that has not achieved FID.